Secondly, the market environment has significantly changed, moving beyond just supply and demand analysis. China is undergoing long-term, structural socioeconomic shifts, particularly in demographics. As I've written, this involves the demographic dividend and demographic shift, because after the demographic dividend, consumption and the service industry, as well as China's economic life, will experience long-term, profound impacts. However, many practitioners and entrepreneurs have not yet realized the significance of the demographic dividend or the decline in total fertility rate. With a decrease in newborn population, the entire society is moving toward a trend of fewer children and an aging population. What does such a change in population structure actually mean? In fact, many people are not aware of this issue. In the next 10 or even 20 years, the population will decline rapidly. The negative consequences of an aging society will become fully apparent. But right now, our total fertility rate is probably less than 1. I think it's just a bit higher than South Korea, and maybe not even as high as our Taiwan or Hong Kong. With this total fertility rate, we can no longer maintain a normal population replacement. For normal population replacement, fertility rate 2. If our population maintains a stable level, but fertility is less than 1, the population is declining. With the population rapidly declining, this year the number of newborns is less than 8 million. Nowadays, there are no more three-person households. Now, a standard family is just 2.6 people. The third issue is society's aging. We are now a deeply aged society. By 2035, our elderly population will be around 400 million, about 25% of the total. For the first time, a country will have over 400 million people aged 60 and above, and that country is China. This is due to an aging population, fewer children, and a demographic cliff. So, in fact, we will see that many aspects of our current environment will continue to undergo profound changes. For example, our large-scale investments in infrastructure such as highways, airports, high-speed rail, hospitals, schools, and kindergartens will result in widespread surplus. We can all see the high-speed rail situation now. As reported, many high-speed rail lines have cities with 3 deaths. Many of these 3 stations can't even open, only 2 can. Lines operate only between core cities, leaving smaller local stations unused. These stations don't open because there's no passenger flow. Although high-speed rail connectivity is basically achieved to every prefecture-level city in central and western regions and economically underdeveloped areas, passenger flow isn't enough to support our transport capacity. Our high transport capacity isn't supported by passenger numbers, leading to many unused facilities along routes. 5 to 10 years ago, we had around 20 million births annually. Now, we're not even reaching half of that. Actually, this is where the real pressure lies. These kinds of structural slow variables will have a huge impact on the future of economic life. There will be a massive surplus of infrastructure, a massive surplus of supply, and the labor force will become increasingly scarce and increasingly expensive. This will lead to significant cost increases and adjustments for many of our labor-intensive industries, especially in consumer service industries. At Jialhua, when we invest, we prefer to discuss those who truly understand modernization, standardization, and digitalization, those who can set industry benchmarks in these areas. Companies that can rely on advances in modern management science, digitalization, automation, and standardization to stay at the forefront of industry development and lead their sectors. Because only such companies will have a chance to win in the future, especially in times of such major changes. For example, in the context of significant demographic shifts, the impact of such structural slow variables on competition, only companies like these can weather periods of rapidly rising costs. A declining population will be extremely unfriendly to labor-intensive enterprises, making it almost impossible to find enough workers. Labor costs are rising. Many young working-age individuals avoid traditional industries. The workforce quality is rising, linked to the nation's development. As we pursue common prosperity, we must enhance worker incomes through primary distribution and by improving workforce quality. In labor capital relations, we must raise workforce income levels. In this process, the level of labor income actually faces both the potential for wage increases and considerable pressure. If we do not rely on improvements in labor productivity and scientific progress, on standardization and modernization, and on digitalization as a driving force, but instead continue to rely heavily on human labor. Even traditional industries like health and retail will be phased out by competitive trends. Your efficiency cannot keep up with rising costs, your marginal returns are diminishing, and there's little room for improvement. The market will eliminate these models. Whether you like it or not, this is an objective reality. That's why beginning to understand modernization, standardization, and digitalization is a lesson that all of our industries, including traditional sectors, as well as consumer and service industries, must catch up on. It's essential preparation that we simply have to do. When the day truly arrives, if you haven't made these preparations, you simply won't be able to keep up with the trends of the times, and in the process, you'll be ruthlessly eliminated. So, some of the changes brought about by social development actually have a significant impact. Thirdly, during this process, due to changes in the economic situation, we can all see this happening. The impact of the past 3 years is clear to everyone. We all hope that after those 3 years, the overall macroeconomic situation would stabilize, that we would see explosive growth, and that the recovery would go very well. However, unfortunately, after we got through that period and moved forward, our economic growth actually showed a very weak trend. Expectations have also not been particularly optimistic, because these expectations reflect the confidence in the long term development of society and the economy. Confidence is extremely important. When expectations shift, when affected demand is insufficient, and when economic growth is weak and the supporting momentum is not that strong or stable, the challenges for future development are actually quite significant. So, as you can see, this is the situation we are facing. Looking at macroeconomic data, China's CPI is negative, hovering at this level for months. It's now in negative territory. Secondly, our broad money supply, N2, has seen a massive increase. It doubled in 3 years, and now it might double again in just 2 years. With these quantitative policies, the impact of your monetary policy hasn't really reached the real economy. It's still circulating within the financial system and hasn't produced the intended effects. Thirdly, we can observe this situation. As the economy continues to decline, the return on investment for real sector enterprises is gradually decreasing. In 2012, as I recall, the return on investment in our real economy was around 12%. But by today, according to 2022 data, I estimate that the actual return on investment is roughly between 5 and 6%. After 20 years, our overall real return on investment has dropped by half. But it's also not profitable, or it's very difficult to make money. So when everyone's ability and interest in reinvesting remain the same, the willingness to invest further becomes quite low, which will seriously hinder a company's ability to reinvest and upgrade in a timely manner. Improving the return rate of professional transformation is a major consideration. What about China's future? First, the country is focusing on interest rates, which will trend downward. Economic development necessitates lower rates to loosen restrictions on the economy and people's livelihoods, all pointing to interest rate cuts. Second, local government debt is significant. The Chinese government needs to issue special bonds and restructure local government debt. Because the total debt is very large, reducing interest expenses becomes a very important policy choice and direction. From this perspective, we have much room for interpretation. When all factors align, I estimate future adjustment is inevitable. It's just a matter of speed and how it depends on surrounding circumstances. From this angle, it's positive for the stock market, but long term, not favorable for the index. China's indices are mostly large cap companies, many of which are financial enterprises. Financial companies have huge profits, accounting for over half the profits among the 5,000 plus listed companies. When interest rates are cut, especially deposit and loan rates in this environment, this undermines bank profitability. Banks are under pressure. Chinese stocks attempt to boost large state owned enterprises, big state owned commercial banks. The reason is our interest rate policies. Our exchange rate policy, as well as our industrial policies and the development of the real economy, have all led us into a somewhat paralyzed and confused situation. It's extremely difficult to achieve both coordinated and healthy, orderly development, while also creating opportunities for flexibility and maneuvering. So it's often said that China has flexibility and resilience. But when people discuss the effectiveness of these policies, like flexibility and resilience, they are mostly looking at it from the perspective of quantitative tools. We think quantitative tools are effective for China's economy, cutting reserve requirements, lowering interest rates, quantitative easing, or issuing more government bonds. But traditional methods become ineffective. It's like a patient with a long term cold, fever, and infection. If you keep giving them antibiotics, they develop resistance, and it stops working.